Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand what we see in the global landscape. You know, as I've talked for many months now, we continue to see improvement in the U.S. and we're starting to see the first signs of Europe coming out of a recession. In fact, this morning we had some good numbers coming out for some general GDP growth coming out of Europe. This is a positive, of course, not only for Europe but also for us, as a lot of the investments that we currently own in our portfolio are global in nature. We're seeing the emerging market economies stabilizing. Of course, their GDP really never slowed down a lot, but we're starting to see a stabilization of their actual markets, meaning they're starting to reverse course from down to up. This is, again, a net positive. Primarily in our portfolios, for our global tactical portfolios across the board, we're primarily invested on the largest percentage in small and mid cap in the U.S. and in large cap U.S.-based indexes and equity-based. Reason? Because as we went into the month of August, relatively stronger was the U.S. We're starting to see some small inklings of emerging markets starting to bounce off their bottom and come back a little bit. I wouldn't be surprised as we get towards the end of August that we start to filter back in some emerging market exposure. Remember when I talked earlier, I said emerging markets were down somewhere around 15 to 20%, the average year-to-date index for many of the emerging market economies down 15 to 20%, when a lot of US-based indexes were up around, let's say, 10 to 15%. Big difference. Again, you want to own what's relatively strong, and you want to sell what's relatively weak. Well, what happens is with emerging markets is, of course, they've dropped 15 to 20%, many of these country specifics. And as they start to bounce off the bottom and they start to regain some traction, they could be filtered back in our portfolio at basically pretty close to their 52-week lows. But they're starting to get relatively strong in performance, which is a great time to add those back to the portfolio. Again, we run a strict strategy. We don't base our decisions on emotion. And one of the problems that I'm finding too many investors face is, again, the number one call that we get into our TV and our radio show is really from emotional investors who are very unhappy, discouraged, and scared, and mostly because of the news media. Remember, news today is 7 days a week, 24 hours a day, and basically news sells hype, hype sells news, basically, is a good way to look at it. So at the end of the day, most of these broadcasts are opinion-based, not fact-based. They always want to scare the investor. They want to tell you the end of the world's coming. Folks, the end of the world is not coming. And it's interesting to see investors who basically been sitting on the sidelines and really haven't made any return the last 2, 3, 4 years. It's unfortunate that these people continue to make emotional decisions around their portfolio. I'm glad to say clients at Resney Wealth Management have done quite well, and they're not making emotional decisions because they hire us to do one thing, which is manage their portfolio, which includes risk management in severe down markets. At the end of the day, a sound investment strategy that's followed is going to be far superior than emotional knee-jerk reactions to the news services and or your personal opinion. Fact-based investing is key in any environment. I want to talk a little bit about interest rates. We're seeing the 10-year basically hit new highs again over the last couple years, as early as the beginning of this week. At the end of the day, I firmly believe rates are going to slowly move up, not fast, but slow, over the next 3 to 5 years. Fixed income investors in general are going to get hurt either in loss of principal or making pretty much zero return. I'm glad to say, clients of Resney Wealth Management, we are out of general fixed income investing and we are primarily in floating rate income investments, meaning floating rate income investments do two things. They give us principal protection from rising interest rates, meaning because of their short-term duration, they normally do not go down much, if at all. And also when rates go up, we can get a correspondingly higher interest rate on the portfolio, so that's a positive. So again, we've made some adjustments and some shifts. Our indicator has told us to do so, and also the facts of interest rates slowly moving up. I wouldn't be surprised that Ben Bernanke and team or the new Fed president starts to curtail the Fed bond buying purchases they've been doing for the last couple years. And of course, this is a positive for the U.S. economy. What it's telling you is the economy is growing. It's growing a little bit faster, and it's able to stand on its own 2 feet. So this is a net positive for people who are invested on the right side of the fence. I firmly believe fixed income investors are going to get hurt a lot. And I firmly believe that equity-based investors who run relative strength are going to be good recipients of positive returns over the next 3, 5, and 10 years. I wouldn't be surprised if this is the next secular bull market we see that could often last another 5 to 10 years. But again, most investors are pessimistic because they listen to too much news. News will get you into trouble, so will emotions. If you're a client of Resney Wealth Management and you have a question about your portfolio, please call us. If you're not a client of Resney Wealth Management and want to become one, we always like taking on new clients who want to improve their situation. Call our office today. Make sure you have yourself a safe and profitable week.